on our last paper of today's session, Appraisal, Inflation, and Private Mortgage Securitization by Abdullah Yavas from UW Madison, Moussa Diop from USC, and Shuang from Kent State. Presenter will be Abdullah Yavas. You have 30 minutes.
Thanks, Changcheng. So thanks for including the paper in the conference. As John Hank said, this is co-authored with Moussa Diop of USC and Shuang of Kansas State. Shuang is actually here with us, so she'll answer your questions in the chat room. I'm sure many of you had your share of appraisal stories. Let me tell you about one of my stories. I had multiple. The last time I sold my house a few years ago, there was a delay in the process, and my agent informed me of the reason. The buyer's bank had to get a second appraisal because the first appraisal was not high enough to qualify the buyer of our house for the loan they applied for. So at the time, I wondered if the lender's decision to get a second appraisal had anything to do with the lender's intention of selling the loan or keeping it in his portfolio. And that's really, in a way, the question we're asking in this paper. So let me start with a little motivational background. In the years leading up to the Great Recession, private securitization of residential mortgages experienced dramatic expansion. Like from 2001 to 2006, non-agency originations increased almost 120%, from about 700 billion to about 1.5 trillion. And non-agency MBS issuance increased 330%, from about $250 billion to a little over $1 trillion. Now, what's more striking is that while private label mortgages constitute about 15% of all outstanding mortgages in 2009, they made up more than half of the foreclosure starts. So given the critical role that mortgage default played in the recent financial crisis, and given the rapid growth of private securitization in the years prior to the financial crisis, it is not that surprising that the role of securitization in general and of private securitization in particular in the recent financial crisis has been studied extensively. So we're certainly not the first paper to address that question. So with that background, so the broader question of interest here is, did adverse selection or reduced incentives for screening, i.e. moral hazard, created by securitization, allowed a higher percentage of bad quality loans to enter the credit market prior to financial crisis, hence contributed to the financial crisis. In this paper, we investigate one component of this broader question, and that is whether there is a connection between appraisal inflation and securitization. Because we know that lenders may have strong incentives to press appraisers to inflate appraisals for loans that they intend to sell. And we also know that appraisal inflation is a major source of soft or private information that creates potential for asymmetric information and adverse selection problems in mortgage securitization. When the bank, for instance, ordered a second appraisal for the buyer of my house a few years ago, the investors were not informed of the first appraisal. In addition, lenders are likely to have more knowledge of any unique features of the subject property not captured in hard data, or of the comparables used in the appraisal, the neighborhood, the local market conditions. Hence, they may enjoy superior information with respect to appraisal inflation compared to investors. Now, this is an important question because we have several narratives about the potential cause of the housing bubble that led to the financial crisis. But appraisal inflation is one of the most consequential of these narratives. Why? Because inflated appraisal leads to insufficient collateral, underestimated LTV ratios, higher loss severity ratios in case of default, and mispricing of mortgage-related products. Indeed, there is a growing body of evidence suggesting that there was widespread inflation in the run-up to housing market crash, and directly linking this type of mortgage fraud to massive foreclosure crisis that we experienced. Okay. Now, there is also extensive evidence of appraisal inflation in securitized loans. Griffin and Matrana and Kruger and Matrana, for instance, they estimated over 45% of privately securitized loans have inflation appraisals, and mortgages with inflated appraisals are more likely to default and incur higher losses. However, despite all these studies, it still remains unclear what role securitization plays in appraisal inflation, because it wouldn't be adequate to draw any inference on this question from the previous studies because they used securitized loans only. Whereas in this paper, we will investigate the impact of securitization by examining and directly comparing the incidence of appraisal inflation in securitized loans and portfolio loans. So to address this question, we will use refinance jumbo mortgages. Why jumbo loans? Because that helps us avoid endogeneity issues related to securitization channel, i.e. differences between GSCs versus private labels. Why refinance loans? Because appraisal inflation is more critical for refinance loans than for purchase loans in LTV calculations. Why is that? Because for purchase loans, the smaller of the appraised value and the purchase price forms the basis for LTV calculations. For refinance loans, however, since there is no purchase price, appraisal value always forms the basis, the sole basis for LTV calculations. In addition, the incidence of appraisal inflation is likely to be more pronounced in refinance mortgages than purchase mortgages because there is no transaction price to serve as an anchor for refinance mortgages. So that leaves more room for subject to value adjustments by appraisers. We also contribute to broader literature on securitization and adverse selection. This is only a partial list, which found sort of mixed results about securitization and adverse selection in mortgage markets. Also related to the even broader literature on the role of securitization in the recent financial crisis. So first task is to come up with a measure of appraisal bias. Because appraisal value needs to be compared to the fair value of the property to measure appraisal quality or appraisal bias. So we will use two approaches for this. First approach, we will use repeated transactions, whereby we will require that a subsequent property sale to be included in the sample. And then we treat the HPI adjusted later sale price of the same property as a proxy for the fair value. And as a second alternative, we will use hedonic estimates of the market value. We conduct both the ex-ante analysis, where we investigate whether lenders factor appraisal inflation in their securitization decisions, and ex-post analysis, where we examine whether sold loans have different appraisal inflation than similar portfolio loans. So this is the ex-ante analysis approach, where on the left-hand side, it's the securitization decision. And as there is one problem, right? That potential endogenous problem here. The reason is decision to securitize can depend on the appraisal bias, but the appraisal bias might also be affected by the lender's intention to securitize. So to enhance the identification of the impact of securitization on appraisal inflation, we will adopt a diff and diff approach, where we compare differences in appraisal inflation between portfolio refinance and portfolio purchase mortgages with differences in appraisal inflation between securitized refinance and securitized purchase mortgages. We have another feature of our empirical design, we will focus on appraisal bias at specific loan-to-value ratios or notches, namely 80%, 85, 90, 95, and 97% LTV ratios. Why? Because at these notches, appraisal bias is likely to have the most impact on mortgage underwriting and mortgage pricing. Mortgage pricing sort of shifts at these notches, and mortgage insurance requirements as well. We will implement our empirical strategy using mortgage origination and performance data from McDash. Most of you are familiar with McDash data, but also combining it with property transaction and characteristics data from Realty Track. Now we focus on the pre-crisis time and include mortgages with origination time ranging from January 2005 to December 2006. Now, why start from January 2005? Because McDash coverage for pre-2005 period is very poor with many missing variables. Why stop after 2006? Because there was a structural change in the private securitization market in 2007, where, as this graph shows, following the mortgage crisis, lenders were no longer able to get rid of loans they initially intended to securitize. The market basically collapsed at some point in 2007. And that's important because it makes it difficult for us to identify the lender's intention to securitize a loan originated in 2007. Right? Are the portfolio loans in 2007 were intended to be kept as portfolio loans, or they end up being portfolio loans because the securitization market has basically collapsed and they couldn't be sold, right? So that's why we stopped at the end of 2006. To give a sense of the data, here are some relevant summary statistics. So we're looking at refinance loans, as I said. When we look at the appraisal inflation variable, underlying variable, the two groups, portfolio and securitized loans, look very similar, with securitized loans showing a slightly higher level of appraisal inflation. Furthermore, and this is a partial list of variables, other variables, at least included here, show that sold loans have lower average borrower credit score, higher cumulative LTV ratio, higher DTI, higher percentage of mortgage with exotic features, higher mortgage interest rates, etc., which together suggests that they are of lower quality on average than loans kept by lenders. Now, as I said before, appraisal bias LTV notches is likely to be more severe than at non-notches. Remember, 80, 85, 90, 95, 97%. These are the cutoff points above which PMI premiums jump and mortgage pricing change. Now, this table shows that portfolio securitized notch loans show significantly higher appraisal inflation than corresponding non-notch loans. And more importantly, we see that while non-notch loans have similar levels of appraisal inflation, we see significantly higher appraisal inflation on securitized non-notch loans than portfolio notch loans. Okay? So notch critical and securitized versus securitized for notch loans critical, according to summary statistics. You should also add that servicers could handle securitized and portfolio loans differently during the default and loss mitigation. Hence, which could affect subsequent transaction price of the distressed securitized and portfolio loans differently. That's why through analysis, sometimes we'll do the analysis excluding distressed sales. But what this table also shows at the last row is that when we exclude distressed sales, results, summary statistics remain similar. So let's start with the ex-ante analysis, where we investigate whether lenders factor appraisal inflation in their securitization decisions. So on the left-hand side, dependent variable is the securitization decision for dummy. We find that for the full sample in column 1, there is no statistically significant relationship between appraisal inflation and securitization. Again, this finding is not surprising because appraisal is unlikely to have a significant effect on average because, as I mentioned earlier, it normally matters only at specific LTV thresholds. And to confirm this intuition, we divide our sample into notch and non-notch loans and re-estimate our model on each subsample. And as expected, column 2 shows that appraisal inflation has no effect on securitization decision on non-notch loans, but it has a strong effect on lenders' decision to securitize notch loans. For our ex-post analysis, here the dependent variable is now the appraisal inflation, measured as the ratio of the appraised valuation at origination to the subsequent sale price, HPI adjusted, of the same property. So column 1 reports different results for the full sample. The variable sec here identifies securitization status and is set to 1 for securitized loans and 0 for portfolio loans. And variable refi is also 1 or 0 variable indicating whether it was a refinance loan or purchase loan. Now we include portfolio and securitized purchase loans in our different analysis as a control group, as this will allow us to directly estimate and compare appraisal inflation on portfolio and securitized refinance loans, while at the same time allowing us to control the potential difference in price appreciation between properties that took out refinance versus purchase loans. The interaction of the two terms, securitization and refinance, sec-refi, is our variable of interest, because the coefficient of this interaction term captures the difference in appraisal inflation between securitized refinance versus portfolio refinance loans, which is the question of interest in our paper. And our coefficient of sec-refi is positive, but insignificant, which indicates that there is no difference in appraisal inflation between portfolio and securitized refinance loans. Similarly, insignificant coefficient of sec variable suggests that properties backing portfolio purchase loans and those backing securitized purchase loans appreciate at the same rate. And we find similar results when we restrict our sample to non-notch loans in column 2. Okay, so very similar to ex-ante analysis. However, again, as in the case of ex-ante analysis, column 3 shows at the key LTV notches, securitized refinance loans are associated with significantly higher appraisal inflation than corresponding portfolio loans. Now, as I said, distressed sale could play a role, and because mortgage property, if it's a distressed sale, the mortgage property may be sold at below market value, which in turn affects appraisal bias calculations. So again, when we exclude loans with subsequent distressed sale and read our analysis, that's on the right-hand side, the results remain qualitatively unchanged. Thus, having documented that securitized refinance loans have higher appraisal inflation, both in ex-ante and ex-post analysis, we now consider whether these loans are more likely to default because of their higher appraisal bias, and whether this additional risk was properly priced in. We define default as the first occurrence of 90-day default, bankruptcy, or foreclosure, either within 12 or 24 months after origination. The explanatory variable of interest now is the interaction term sec and notch, and its coefficient will tell us the difference in default between securitized and portfolio notch loans. This is a partial list of the variables we actually used in the paper due to space restrictions. And our results show that on average 12-month and 24-month default rate on securitized notch loans are higher than on portfolio notch loans. And furthermore, after we divide our sample into cash out and term refinancing loans in columns 1 and 2, we find that the documented increase in default on notch loans is really driven by cash out refinancing. When we look at term refinancing notch loans, we don't see statistically significant difference. Given the time constraint, I will go over the next three tables a little bit quickly. So next we look at whether this additional risk due to from inflation, appraisal inflation, is priced in. That's important because if the additional risk is priced in mortgage rates or MBS prices, then the previous findings are not sufficient to claim that there is adverse selection in private securitization. Rather, they will simply show that there are differences in lenders and investors' risk preferences. So in this table, we regress mortgage rates on the same set of variables as in our default model. And overall, we find no significant difference in mortgage rates charged on securitized and portfolio notch loans. Now, I should add that we're unable to confirm that whether lenders were compensated for the additional risk by other means, such as points and other fees, because we only observe interest rates in our data. Nonetheless, any such points or fees would likely be to be kept by lenders rather than passed through to investors in securitized mortgage products. It doesn't eliminate the concern or the question we're raising in this paper. Another analysis we do is we test the argument that local and small lenders have more knowledge of any unique features of the subject property, or the neighborhood, or the comparables in the appraisal. And they know the local market conditions or where the market is heading better. Hence, these small lenders may enjoy more asymmetric information with respect to appraisal inflation. As you're probably familiar with, in the US, a lot of lending is done by local or regional small lenders. Indeed, columns 1 and 2 show no difference in appraisal inflation between securitized and portfolio notch or non-notch loans originated by large banks. In contrast, it's the small lenders who appear to take advantage of their local market knowledge when securitizing loans. Column 2 prime shows that securitized notch loans issued by small lenders have higher appraisal inflation than portfolio notch loans. And so this really reinforces the argument that asymmetric information plays a key role in the relationship between appraisal inflation and securitization, because it's the small lenders have more asymmetric information compared to large lenders. Okay. Last analysis we do is we explore the role of Lender-MBS issuer affiliation on lenders' propensity to take advantage of information asymmetry about appraisal quality when selecting which mortgages they sell to MBS issuers. The rationale here is that affiliated lenders should be more motivated to conduct additional screening during underwriting in order to accurately assess mortgage risk and pricing and servicing rights. I will not go through in details of how we establish the Lender-MBS issuer affiliation. We don't observe it directly, but we use a proxy to capture that. And what we find is that for affiliated loans, loans where lender and the issuer are affiliated, there is no difference in appraisal inflation between portfolio and securitized loans. But when we look at securitized unaffiliated notch loans, that's where we see the significantly higher levels of appraisal inflation compared to unaffiliated portfolio loans. So what we conclude here is that lenders exploit their information advantage about appraisal quality to benefit themselves and related parties in the secondary market. We do some robustness checks. We control for impact of servicer and we control for impact against servicer and lender effects, and the results remain. We also redo analysis using hedonic price estimates to infer appraisal inflation rather than the repeat sales. Again, results continue to hold. Thus, we conclude that our findings represent strong evidence of adverse selection in securitization based on appraisal inflation. In conclusion, I would say one implication of our results is that private securitization led to lower loan origination quality prior to recent financial crisis through adverse selection channel, through appraisal bias. Now, it is possible that some of the deterioration in observable loan quality might have been captured in the pricing of mortgages and mortgage-backed securities, despite the evidence we provide otherwise. However, even if the secondary mortgage market somehow manages to price all this properly, the ability of the lenders to sell lower quality loans to investors because of securitization and through the appraisal bias channel will give them incentives to lessen the lending standards and originate lower quality loans that they wouldn't have otherwise, whether it's priced or not. So this adverse effect on loan origination quality is obviously a crucial concern for financial stability of the markets, hence critical for policymakers. Again, regardless of whether the deterioration in loan quality is fully priced or not. And I would conclude by saying that our findings suggest that we need proper policies and regulations or innovative security designs to reduce asymmetric information with respect to appraisal inflation and then the perverse incentives created by securitization with respect to appraisal inflation. Thank you.
Thank you, Abdullah. Our discussant will be Changcheng from SMU. Yeah.
Okay. Changcheng from SMU. Thanks for organizer to ask me to discuss this paper about appraisal inflation and private mortgage securitization. So Abdullah already presented all the key results. Let me just summarize the key thing of this paper in the first page. So what this paper is trying to do is to study the relationship between the appraisal inflation and the mortgage securitization. So different from the previous literature, this paper focused on a special sample, which is the jumbo refinance loan, to remove other concerns, such as the concerns for GSE securitizations, and for compared to the purchase loan is about anchoring and other issues. The key result of this paper is saying that the mortgages with higher appraisal inflation around the key LTV notches have a higher probability of securitization. And this also have consequences. So they show that the inflated appraisals on sold notch loans are associated with higher default. They trying to dig a little bit deeper to understand what's the mechanism. So they show some evidence about over-selection using the comparison between small and large lenders, where the lenders likely explore their information advantage. So my overall comments is that it's an important question in the housing market, as also in the first page of Abdullah's slides. So the appraisers is help to facilitate the transactions in the huge housing market. And if you consider appraisers as a financial intermediary, think about with real estate agent and banks. So as one type of financial intermediaries, their behavior will be affected by several other factors. For example, the information environment, the asymmetric information, and their own incentive structure, such as their relational contract, where they are pressured by the banks about this kind of relational contract. And their bias of this appraisal inflation will have consequences on home buyers and home sellers, their mortgage decisions, and largely could be for financial health of all these originators. So that's what we'll have this kind of policy debate in the sense that if the appraiser have inflation, whether we should use the AVM, we use machines and robots to replace human appraisals. And recently, this with the development of all these machine learning and AI, there's even the new business model of this instant buyers in the market in US. So this is a few examples in the headlines in the last few years about robots replacing appraisers. And the third one is the news about the instant buyers, like the Redfin, Zillow's Open Door, where they start to catch more market shares in US. So my first point is trying to understand what's new in this paper. So appraisal inflation, this notion is well documented in the literature. So to take a few example, this Kruger and Marana paper, they use one lender, the New Century Financial Corporation, and they show that 45% of the purchase loan appraisers exactly equal the purchase price. So if you look at the distribution here on the right, it shows that 45% on the zero, which is the appraiser price minus contract price, and mostly is on the upward, means it's above contract appraisals, and there is only a few below purchase price appraisal. So that's kind of the documentation with one bank. And then they also show that appraisal bias predicts loan delinquency and the MBS losses. So my team also have some work on this field where we use the appraisals from one GSE, the universal of full appraisals from one GSE between 2013 to 2015. We document very similar facts using the purchase loan. About 31% appraisals in US punch at the contract price, and the at contract and above contract. So this means this appraisal inflation appraisals will predict higher mortgage defaults. So what's new in this paper? So my reading is there's two things. So first thing is because you focus on the refinance sample. So you cannot use like bunching or anchoring to define. So you need an alternative way to define the appraisal inflation. So the author do a careful job in using the local HPI adjustment to define the appraisal inflation. And the second thing is what the author already emphasized is that it's not only linking this appraisal inflation, this kind of bias, to the mortgage default, but also linked to some actions in the middle, which is the relationship between appraisal inflation and the mortgage securitization. So that's something new in the literature. So four simple comments. So the first thing is about sample. So when we study appraisal in this literature, they often have an issue of sample selection in the sense whether the sample of appraisals are all successful loans or is the sample of appraisals full appraisals, including unsuccessful loans. So this could potentially bias some of the result or especially influence the interpretation. So potentially the appraisal inflation or this kind of upward bias could influence the loan approval. And after loan approval, it could influence more about mortgage securitization. So there's a link in between about the loan approval. However, if you only have the data of all the approved loans, then you only capture the effect on the second side from the approved loan to the mortgage securitization. So I could think about the potential bias in the sense that maybe if the unsuccessful loan are unlikely to be securitized, then the current estimation might be a lower bound or underestimation of the effect of appraisal inflation on securitization. So in the sense that the appraisal inflation is actually more important, but with the sample, it cannot be really documented in that large size. So the second comment is about the difference in different specifications, so especially about the variable definition. So here, what the author is using is making a simple assumption and a reasonable assumption that the ratio of appraisal value to HPI adjusted price will remain constant over time in the repeated sale. So this is a fair assumption and it's reasonable. And then they start to define the variable. The refinance loan dependent variable is the ratio of appraisal value to this HPI adjusted price. But when they look at the sample of the purchase loan, the comparison, the dependent variable is the ratio of the transaction price at the origination to the HPI adjusted price. So trying to think about this kind of comparison, there seems to be some inconsistency there. So I would like to see if you make this consistent, then whether the results do hold, that is, the definition of the purchase loan dependent variable should be the ratio of the appraisal value at the origination to the HPI adjusted price. So then the assumption will help to control for this kind of indifference between the purchase loan and the refinance loan, and what you capture should be the real inflation. The third comment is about interpretation. So the key result what this paper finds is the inflated loans around LTV notches are more likely to be securitized. So it could be classical, have two interpretations. That's urban selection, moral hazard. The authors take a lot of effort and trying to use data and some other testing to find a support of adverse selection. So in this case, adverse selection would be the inflated loans are more likely to be securitized due to the private information of the lenders. But it could be also the moral hazard here, which is similar to the spirit of Keys et al. Paper when they used RD of 620 FICO score. So if it's about moral hazard, it could be the inflated loans are more likely to be securitized due to the lack screening effort around the LTV notches from the banks. So it's a difficult question, but I'm trying to encourage also to think more carefully whether there are some different ways to find some evidence to support or support this kind of moral hazard stories to make it complete about interpretation. So the last comment is a suggestion to dig a little bit more carefully in this consequences. So the author is trying to study this consequences about default. So if we think about the default, why there's more defaults, the default is often due to two reasons, right? First is the pre-origination selections, right? If you have the low quality borrowers, or is the post-origination shocks. When we study the appraiser bias, this is likely to affect the delinquency through this pre-origination selection. So in that sense is that we have the vulnerable borrowers there, and this kind of inflation will make them even more vulnerable. So in that sense, we could think about a specification where we could use some other measurements in the existing data, trying to label who are the vulnerable borrowers. For example, we can use the FICO groups, or we can use whether the loan-to-value ratio is above 80. So this time it's not on the notches, but as long as whether it's vulnerable, above 80 or above 90 or 95. And then interact with the main specification. So this will see a more clear interpretation about why we see this kind of consequences. So that's all my discussion. So in general, it's an important paper and document interesting relationship between the appraisal inflation and the securitization. So my key suggestion is there'll be more discussion on the interpretation of these interesting facts. Thank you.
Abdullah, do you want to have a quick response before I open to?
I just want to thank you for your insights and the nice background information you provide on appraisal industry. You put a lot of effort into discussion. Thank you. No, these are good suggestions. I don't know, with respect to second point, I don't know of any evidence that somehow it's easier to securitize a loan depending on whether it's right above, right below a certain notch. But that's, in the spirit of Keys et al. Vis-a-vis FICO score. But that's also a really good suggestion, certainly worth checking. Shuang, do you have any additional comments, responses, or replies?
Yeah, can you hear me, Abdullah?
Yes.
Yes.
Can you? Oh yeah. First of all, thank you so much for the nice discussion. It's very insightful. Those comments are very, very good comments. I just want to respond to. Definitely, we need to discuss as well as do more analysis. As for your comments too, I just want to say. Whenever we are trying to design the difference in difference design, why we have, if you think about difference in difference design, it's going to be, you have a treatment group, then you have a control group. So the only thing we need to change will be the appraisal part. So that's why we have, if you look at everything, will be valuation at different point. So 3 point will be the true valuation. There's just 1 point should be treated with the appraisal. So that's why we have the design. So that's the only thing I want to add. Yeah.
Any comments from the panelists and attendees? Abdullah, I do have comments. I don't know if this is a question on comments. It's very interesting you're looking to this issue through the adverse selection or moral hazard issues and then judging by the default risk. But recently I have been working with the Appraisal Foundation and then do some standardized modeling. We have a lot of industry people, but no one ever think about the default issue. Default is out of their concern. They only concern say, well, whether we can standardize the model, whether there's a data error or there's a model error. So they sort of try to look down the machine learning and those kind of things, use more traditional regression model. Of course, all the appraisal, they don't do the regression analysis as housing economists. We do repeat sale orders. They just, but no one ever think about the default risk like you guys think. I'm thinking why this is the case, because for the lender or whoever care about the appraisal value appraisal, default is not their problem probably. But if you think the relationship, probably if you over appraise it, then you give biased estimate of loan to value ratio. That loan to value ratio is obviously related to default. But the appraisal industry, just no one ever think about that way. It's very difficult to convince them. I'm economist. It will be very easy for me. But if I talk to the Bank of America or Wells Fargo, those appraisers, they don't care about it.
So there are different reasons why there are all these automation initiatives. Part of it is related to taking out some of the human element that could lead to the kind of problems we're discussing here. But the thing that these models won't capture is precisely the kind of problem that we're addressing here, soft information, right? They can check and control for all the hard information, observable stuff, but they cannot have the insight about the local market conditions, something unique about that property, or something.
Industry do care about the soft information. What their language is, they use cascade model. They use layers of model to verify that. That's the way they do soft information.
But that's by definition, soft information is something they cannot observe. They can try to infer it, but it's not easy. I mean, if there is something quirky about that property, or because not all physical characteristics can be included, or especially unique features, something about the neighborhood, or something property next to it, or something about the comparables, and So
I understand. What they refer to actually is what you refer is missing sort of data can be updated, so that they refer to cascade model. Say, well, they have layer of layer model. If this model don't pass, go to the next layer, go to the next layer. Finally, there's one model catch it. So they say that's the perfect model.
Yeah, and those models will work very well, particularly for more homogeneous properties. Like condos, will be ideal, or cookie cut sort of houses. But when you start looking into properties that are more heterogeneous, then it's hard to capture everything in the hard data.
Any other comments?
Hi, just one quick question about the time variation. So do you have any sense of the periods in which the problem is sort of most striking?
We haven't. I mean, we have a narrow sample period because we want to focus on pre-crisis levels, but we cannot go before 2005 because of the quality of the McDash data before 2005. I mean, other studies have looked at extended periods about appraisal inflation. I cannot recall if it gets worse in certain periods, or maybe I don't know if Shuang does, or our discussant looked at that literature, share some graphs with us. Maybe he'll have it, but I just don't remember if the literature found that any big sort of changes at certain time periods.
Because this is why I'm saying this, is because this is one fundamental difference between the mistakes made by human valuers and the mistakes made by automated valuation. That sort of automated valuation can be equally wrong, but then it's very predictably trend chasing in a sense, right?
Right.
While human valuers is driven by sentiments. So that's why I was wondering.
Right. Like we're going through a very, very unusual, for instance, time period where I think first time ever the average annual price increase is more than 20% in the US. And it's all due to supply constraints and relate to financial crisis partly. Many developers, small scale developers went out of business, went to different jobs, never came back, but other issues as well. So like if you don't capture that and you don't realize that this is like one time and it will, well, as the supply comes back, things will go back to normal. Maybe we'll have oversupply at some point, but right, if you put this as part of the trend, you're gonna end up with wrong conclusions for forecasts. Yeah.
Yeah. Thanks. Yeah.
Any other comments, questions? If not, let's wrap up this year's real estate program, real estate and urban economics program for the ABFER annual meeting. We have 12 outstanding, even though we got a large submission, we finally select 12 high quality papers. I really appreciate all the support from the presenters and participants, and also the teams, Coach and Susanna, Noor, and others to support this program to make it work. I really hope next year, we hope we will have an in-person meeting in Singapore, because I'm already missing the laksa, all those Hainan chicken rice. So we hope we can, our jumbo seafood crab,
Yeah.
we hope we can have a live meeting next May or June in Singapore or in somewhere in Asia. Tianfu, do you want to have a few words?
All right, thanks, Yong-Han. First of all, I'd like to thank all the participants and also Sheraton Stein for help and Yong-Han for helping to put together this program, and so Wen-Lan. And I hope to be able to see you again in person, hopefully next year. Thank you very much.
Before we end,
Thank you.
let's give a big hand to Coach Chen, Susanna, Noor, and all the supporting team to make this work.
Thank you.
Thank you.
Thank you. See you next year.
Thank you.
Bye-bye.
Bye.
Thank you.
Thank you.